Understanding money laundering risk in banking requires more than knowing the three stages of placement, layering, and integration. It requires understanding which specific products, customer types, and transaction patterns create the most significant exposure in each banking segment. Banks are the primary channel through which criminal proceeds enter and move through the financial system. That is not a criticism of the banking sector, it is a function of the banking sector's central role in the global economy. Every significant money laundering case involves a bank at some point in the chain. The CAMS examination approaches banking ML risks by segment: retail and commercial banking, private banking and wealth management, corporate and investment banking, and correspondent banking. Each segment has its own product set, its own customer profile, and its own typologies. Two risk categories cut across all of these segments: shell and shelf companies, and concentration accounts. These are not segment-specific risks. They appear in every banking context and serve the same function in all of them, obscuring beneficial ownership and creating a break in the audit trail that makes the origin of funds difficult to establish. Shell companies and shelf companies are two of the most important concepts in the entire AML curriculum, and the distinction between them matters for the exam. A shell company is a legal entity that has no significant assets, operations, or employees. It exists on paper. Its purpose in a money laundering context is to hold assets, receive and transmit funds, or enter into contracts in a way that distances the real beneficial owner from the transaction or asset in question. A shelf company is different in one specific way. It was created in advance by a company formation agent and held placed on a shelf until sold to a buyer who wants immediate access to a company with an established history. The AML risk of a shelf company goes beyond simple ownership obscurity. A shelf company has an apparent operating history, years of incorporation, sometimes even filed accounts. Politically exposed persons, PEPs, are individuals who hold or have held prominent public functions. The category includes heads of state and government, senior politicians and political party officials, senior government, judicial and military officials, senior executives of state-owned enterprises, and important political party officials. It also extends to close family members and known close associates of PEPs. Because corruption and the abuse of public office frequently involve the placement of assets in the names of family members or trusted associates, the AML rationale for PEP status is precise. A person holding a prominent public function has both the opportunity and the institutional access to abuse that position for personal financial gain. They can direct contracts, influence regulatory decisions, approve expenditure, or otherwise extract value from public resources. That does not mean PEPs are corrupt. The overwhelming majority are not. PEP status is a risk indicator, not an allegation. What it means in practice is that banks must apply enhanced due diligence to PEP customers. Concentration accounts are a risk category that does not always receive the attention it deserves, but it is specifically tested in the CAMS examination. A concentration account, sometimes called a suspense account, or an internal clearing account, is a bank account used to temporarily hold funds belonging to multiple customers before those funds are allocated to their individual accounts. The AML risk is structural. When funds from multiple customers are pooled in a single account, the individual transaction trail is broken. A payment that enters the concentration account from customer A becomes indistinguishable from funds belonging to customers B and C, once all three sit in the same account. This breaks the link between the individual customer, their source of funds, and the eventual destination. A well-designed concentration account policy requires that individual customer information travel with each transaction through the concentration account, so that the audit trail is preserved even when funds are temporarily pooled. The problem arises when that discipline breaks down, or when concentration accounts are deliberately exploited to obscure the origin of funds. In a deliberate exploitation scenario, a criminal uses the concentration account as if it were a layering mechanism, placing funds into the account from one source, and drawing them out to a different destination, relying on the pooling effect to obscure the link between the two. Concentration accounts require specific controls: no customer transactions directly to or from the account, individual transaction identification maintained throughout, and reconciliation and oversight procedures. Retail banking serves the broadest customer base, from consumers to medium enterprises, creating the widest surface area for criminal exploitation. Cash is the primary risk. Deposits, withdrawals, and exchanges are the most direct mechanism for placement, introducing criminal proceeds into the financial system. Prepaid cards combine accessibility with anonymity. While credit union accounts present risks when member oversight is weak, and institutional scale means less sophisticated controls. Trade finance products like letters of credit create risk through documentation complexity. Falsified invoices and phantom shipments can be embedded in legitimate transactions. Falsified invoices and over or undervalued goods can all be embedded in legitimate-looking trade finance transactions. Credit products create risk through the loan-back mechanism. Criminal funds are used as repayments on loans in legitimate names to create a lawful wealth source. Generating documented debt satisfaction creates the appearance of lawful wealth. That is the distinction that matters for AML response. Private banking and wealth management present a distinct category of AML risk, one characterized not by cash volume or transaction frequency, but by the scale of individual customer wealth, the complexity of the legal structures used, and the close relationship between private bankers and their clients. Private banking clients are typically high net worth individuals who hold significant assets, real estate, financial investments, business interests, and sometimes complex cross-border structures. The relationship manager in a private bank knows their client personally and in detail. That relationship creates value for the client, but it also creates risk for the bank if the relationship manager becomes a protection for the client rather than a gatekeeper. Trusts are a significant risk vehicle in private banking. A trust separates legal ownership, held by the trustee, from beneficial ownership, held by the beneficiary. Legitimate trusts serve genuine purposes: estate planning, asset protection, and family governance. Corporate and investment banking creates AML risks through the scale and complexity of the transactions involved. Where retail banking risks are often characterized by high volume and lower individual values, corporate and investment banking risks involve lower transaction volume, but dramatically higher individual values, and more complex transaction structures. Wire transfers are the primary transaction type in corporate banking, and the primary layering mechanism. A single wire transfer can move millions of dollars across multiple jurisdictions in hours. The speed, the scale, and the cross-border nature of corporate wire transfers make them one of the most powerful tools available to sophisticated money launderers. Fundraising risks arise when banks raise capital for clients through debt or equity instruments. The origin of investor funds, who is actually providing the capital that purchases the bonds or shares, is a critical AML question that is not always answered adequately. Mergers and acquisitions transactions create risk through the due diligence process or the absence of it. When a company is acquired for a price significantly above its apparent market value, the excess payment can represent the integration of illicit funds into what appears to be a legitimate corporate transaction. High-risk corporate banking products include payable through accounts, which allow a respondent bank's customers to conduct transactions directly through the account, effectively extending banking services to customers the bank has never verified. A correspondent bank provides services to the customers of a respondent bank without direct knowledge of who those customers are. It inherits the respondent's entire customer risk, filtered only through the quality of the respondent's AML controls. Nested accounts amplify the risk. A second respondent behind the first gives the correspondent third-degree exposure to customers it has no knowledge of. And one prohibition applies universally: no correspondent relationships with foreign shell banks, banks with no physical presence and no regulated affiliation. Due diligence before opening a correspondent relationship must go significantly beyond standard CDD. It must include assessment of the respondent's AML controls, regulatory status, ownership structure, and the jurisdiction's regulatory environment. Assess the program, not just the entity. That is the standard that matters for correspondent banking. Capital markets present AML risks that are distinct from those in retail or corporate banking, primarily because the layering techniques available through securities markets are sophisticated, rapid, and difficult to trace. The most common layering technique involves purchasing securities with criminal proceeds, then selling them shortly afterward, to generate proceeds that appear to be legitimate investment returns. The buy and sell cycle creates a paper trail pointing to an investment. Pump and dump schemes use networks to artificially inflate the price of a security, then sell the inflated position, generating gains. Insider trading proceeds are also laundered through capital markets, the criminal positions accordingly, appearing as a skilled trade. Card risks complete the retail picture. Prepaid cards allow value to be loaded in small amounts and combined, effectively structuring a placement. To close this lesson, banking ML risk is not a single phenomenon. It is a collection of segment-specific risks.